Says live. Hey everyone, welcome back. We've got the minutes coming out in seconds here. Market right now slightly green. Let's see what happens. I'm gonna pull the minutes up as well. I've got Wall Street and the notes of Wall Street ready to go. Okay, here we go. They should be out now. So waiting for those to actually populate on the webpage. We're going to go through these notes. Remember, we're looking for any kind of remarks on the potential, obviously, for disinflation, but also wages. How serious is the Fed going to be about waiting for these wages to come down or stabilize? Okay, Fed sees it says a few officials favored going potentially back to the 50 BP hikes. I'm actually not a big fan of that. I think that would really affect their credibility for a bit, and it's already been pretty well damaged. You've got Fed saw upside inflation risks as key factor in shaping outlook. Well, obviously, they say that every single time. Waiting for a little bit more here on the minutes. Okay, let's see here. I've got the entire set myself as well. Okay, the first thing I'm going to look for is I'm going to look for any comment on deflation. Wall Street so far not mentioning anything. No mention of the word deflation at all. Let's go for disinflation. No mention of the word disinflation at all in the minutes. I wouldn't be surprised if they scrubbed some of this after the market started moving up. Although yields did move up as well, which tightens financial conditions. So far, coming in as expected here with some Fed policymakers favoring stronger half point. That's the only thing I'm getting from Wall Street. So go back to the actual minutes themselves. Let's see here. Staff review of economic situation. This was on February 1. Consumer price inflation, 12-month PCE, solid total non-farm payroll. They refer to getting down to 3.5% on unemployment. So far, nothing new here. We've got consumer price inflation eased in November and December. Here we go, but remained elevated. Total PCE inflation was 5% over the 12 months ending December, 1.1% lower than the October figure. That's great. Core PCE inflation, which excludes changes in consumer energy prices and many consumer food prices, was 4.4% over 12 months. Obviously still higher than we want, but down 0.7% from October. So this is sort of their review. Foreign economic growth slowed in the fourth quarter, weighed down by COVID-related slowdowns of China. However, obviously, we know that China is reopening. Financial conditions, elevated borrowing costs, credit quality remains strong. Market implied Fed funds rate path was a little changed on net. This was before, obviously, the numbers came out. That's moved up from about 4.9% to about 5.36% as a terminal Fed funds rate this morning. Secured markets, repo rates, roughly the same. No stress on repo. Elevated daily demand on the reverse repos. This is really banks having excess cash available that they're depositing over at the repos. There's been a lot of concern that would actually lead to treasury yields going higher, because why would you buy treasuries if you just park it into the repo market? So far, we haven't seen that kind of stress. Key phrasing here, the minutes said, quote, almost all officials agreed it was appropriate to raise interest rates by 25 basis points at the meeting, while a few favored or could have supported a bigger 50 BP hike. So far, that's the only thing Wall Street is picking up on. Headline data here, Fed notes importance of financial conditions matching policy. It's actually, I said that in the prepare for the FOMC meeting. That's one of the quotes I picked up from Jerome Powell last time. Wall Street reiterating that right here. And financial conditions have tightened. Obviously, you've seen the 10-year Treasury yield pop up to right now. Let's see where we are right now. But this morning we were at 3.94%, dropped to about 3.9. Right now they're sitting at a 3.91. So we're pretty stable so far. Indices all positive at the moment as this data is coming in. So far looking relatively chill. Relatively quiet. Several officials were concerned about the impact of higher rates on commercial real estate. Discussed the risk to commercial real estate. S&P, okay, slightly pairing gains, fine. Let's go ahead and keep going here in the report. Again, no mentions of disinflation here, despite how many times Jerome Powell talked about that. Consumer price inflation eased in November. We talked about that. Staff review of financial conditions. We went through this. Credit remained broadly available for businesses and households. Strong credit quality, but remained tight for lower-rated borrowers. There's a lot of talk about tightening loan standards. Personally, I'm only seeing that at lower tier credit borrowers. Higher tier credit is still widely available. A lot of folks are worried about home equity line of credits maybe getting frozen. So far, we're not seeing any kind of risk to that, despite facing real estate price declines. Commercial real estate loan growth on domestic banks' balance sheet remained robust. Meanwhile, the issuance of commercial-backed mortgage-backed securities remained slow in November. Credit broadly available in residential mortgage market for high credit score borrowers who meet the standards for conforming loans, ability to repay. Home equity line of credit balances at banks continued to grow into the fourth quarter on net, potentially reflecting homeowners using HELOCs as a preferred way of extracting equity in the presence of current higher mortgage rates. Some of the HELOCs right now, you're looking at 9% on HELOCs. Overall credit quality remains strong, although there was some deterioration for credit card and auto loan borrowers, oftentimes also lower credit score borrowers. The volume of corporate bond rating downgrades outpaced upgrades in December. Leveraged loans experienced a notable net rating downgrades in December. This is one of the potential areas you could see a black swan is basically private companies or highly leveraged companies with low credit, low cash flow, potentially defaulting. So far, we haven't actually seen a substantial rise in corporate defaults or bankruptcies. Started ticking up, but we're still below trend from 2019. Credit quality of households remained strong. Some signs of deterioration. Delinquencies. Oh, this is interesting. Delinquencies for FHA mortgages. These are your 3.5% down. These credit loans or these loans can go down to about 620 on your credit score, sometimes even as low as 580. Delinquencies for FHA increased slightly, but overall mortgage delinquency rates we're still near pandemic or pre-pandemic lows. Delinquency rates for credit cards and auto loans continued to rise during the third quarter, while delinquency rates on credit cards were still relatively low. Those on auto loans rose above pre-pandemic levels. So there you go. On autos, you're starting to see some cracks there on credit. So far, it doesn't look like, let's see, measures of hedge fund leverage have decreased since the pandemic shot. Vulnerabilities associated with funding risk were characterized as moderate. So far, nothing super scary or unexpected from this report. On financial conditions, which have moderated a bit in recent weeks. This is from Wall Street. After strong performance in the last part of 2022, officials said it was important that, quote, financial conditions be consistent with the degree of policy restraint, right? But they've already tightened, that's fine. You've got head of currency strategy at BBH with an immediate reaction. A few means it wasn't just Mester and Bullard that favored the 50 basis point hike. That's actually an interesting observation that maybe it wasn't just two members of the Fed that wanted to go 50. Maybe you had more voting members. Yeah, Wall Street now picking up. This is one of the first things I actually searched for, as you saw in the video. Word count, 0 mentions of disinflation versus 91 mentions of inflation, down from 103 in the last meeting. But they totally scrubbed the phrase disinflation from this report, even though Jerome Powell mentioned it a million times during his presser. The forecast for the U.S. economy prepared by the staff for this FOMC meeting had somewhat higher path of a real rate of GDP. That's actually something Jay Powell mentioned as well, that if he had to redo the summary of economic projections now, he would actually write in a higher terminal GDP rate for this year. Fourth quarter 22 was stronger than expected. Real GDP growth was weaker than previously forecast at the end of 2022, but again, forecasted to be stronger in 23. There's a lot of talk. We might not see that recession in 23, that it might get delayed until 2024. The staff forecasts continue to include a pickup in real GDP growth starting next year, although projected output growth in 24 and 25 remains below the staff estimate of potential output growth. That's where the Fed's also now starting to talk about, look, recession might get delayed till 24, 25. That's interesting to see them mention that here. The level of real output was expected to move down, to the estimate of potential near end of 2025. The level of real output was expected to move down to the staff's estimate of potential near the end of 2025. That's interesting. So really, they see this is a way of them really teasing that this process is going to take a little bit longer. Let's sit up here, if you don't mind, for a second, just because it's getting a little chilly. Sorry, Christian. Okay, so, let's see here. That's total PCE. That's fascinating that they're talking about getting to a natural rate at the end of 2025, where we're really matching Fed policy with their expectations of the economy. This is the first time I've actually seen them talk about 24, 25. With the effects of, other than the summary of economic projections, with the effects of the supply-demand imbalances in goods markets projected to become less tight, the staff continued to forecast that inflation would decline further over 2024 and 2025. On a four-quarter change basis, core goods inflation was projected to move down further this year and then remain subdued. Housing services inflation was expected to pick up later this year and then move down, to peak later this year and then move down. It's interesting. So later this year for housing, a lot of folks have been estimating Q3, by the way. Q3 for housing. And then core non-house services inflation was forecast to slow as nominal wage growth eased. With steep declines in consumer energy prices and substantial moderation in food inflation expected for this year, total inflation was projected to step down markedly for the year and then track core inflation over the following 2 years. Fine. So far, this is all relatively expected. Here's an interesting tidbit from Wall Street. Wall Street saying here the staff judged that asset valuation pressures remain notable. In particular, the staff noted that measures of valuations of both residential and commercial properties remained high. Yep. That's exactly what I think the Fed wants to do. They want to crush housing. They don't care so much about the stocks. They want to crush housing. And so they're noting that both commercial and residential properties remain high. That's why we're going to be very, very patient with my startup house hack. Property price, okay, and that the potential for large declines in property prices remain greater than usual. Whoa! That's in line with 10-year treasury yields moving up. The Fed basically giving you a big middle finger to real estate right here. Let me read that again so you have this word for word from them. The staff judged that asset valuation pressures remained notable. In particular, the staff noted that measures of valuations in both residential and commercial property markets remained high, and that the potential for large declines in property prices remained greater than usual. In addition, the forward PE ratio for the S&P 500 remained above its median value despite the decline in equity prices over the past year. This is a lot of what we've been talking about on the channel about potentially those consumer staples not actually having declined substantially. I mean, you look at McDonald's year over year, you're positive. What's it?
The audio's windy.
Oh, audio's windy. Someone's saying audio's windy. Here, let's get back out of the plane and we'll fix the audio.
I think
you want to back up a little bit?
I think it's worse.
Oh, it's worse out there? Okay, hold on. We'll go inside a little bit. We'll make it better. We can fix this. Okay, here we go. There, no wind out here. Okay, a few more minutes. This is okay. So that's really interesting about valuations. But remember, consumer staples kept the costs or kept the valuations of these companies pretty high. Look at McDonald's year over year, right? You're positive, and that's crazy. I mean, tech and growth and the companies with big earnings, they're the ones that had the big fall, especially some of the SaaS businesses. It's insane. Look at Cloudflare, for example. But you already know the market's been pretty crazy. So we don't have to talk about that. But I think staples are what are actually propping up the valuation of the S&P 500 right now, and I think that's where the danger is. Sluggish growth in real private domestic spending expected.
It's lagging pretty bad. I gotta be.
Oh, let's go outside. We'll go outside. We go in the metal tube, and the internet gets bad. I mean, that kind of makes sense. Anyway, the discussion of current economic conditions. Participants noted that real indicators pointed to modest growth in spending and production. Nonetheless, job gains have been robust in recent months. Inflation has eased somewhat, but obviously remained elevated. That's fine. This is all old news. We know that. Average number of hours worked fell. Okay, here we go. Let's look at this. This is probably the last important piece right here. We're almost done with the minutes anyway. A few participants remarked that some business contacts appeared keen to retain workers even in the face of slowing demand for output because of their recent experiences of labor shortages and hiring challenges. That's actually a really interesting note from the Fed. The Fed's basically saying, hey, look, we realize maybe job openings are staying high and unemployment is going to be even more of a lagging indicator because people are frustrated that it took so long to find the folks in the first place. Nevertheless, participants noted tentative signs that imbalances between demand and supply in the labor market were improving, with some job vacancies and payroll gains declining somewhat from high levels. The average number of hours worked fell or falling, but that was before the last jobs report because it popped right back up. So that's already outdated news right there. Some participants commented on the recent reduction in temporary employment, which previously had often preceded more widespread reduction in labor demand. That's interesting. Recent reduction in temporary employment. So in other words, if you have less temporary workers, that could basically be a leading indicator to more unemployment essentially occurring, less jobs growth, right? And that's actually kind of what we're seeing in the earnings calls as well of companies is less wage pressures, more wage availability. Just go read the earnings calls for Lyft. If you want to read one earnings call, go to Seeking Alpha right now, type in Lyft, go to transcripts, boom, read that. You'll see labor supply is exploding. Under appropriate monetary policy, participants expected a labor market demand and supply to come in better balance over time, easing upward pressure on nominal wages and prices, right? Remember, Jerome Powell talked about no expectations of wage price spiral. Participants noted core good prices had declined notably. That's fine. Downward pressure on goods prices resolved from resolving supply chain bottlenecks. That's fine. Smaller inventories leading to, well, yeah, that's actually interesting as well, as a lot of companies have been really setting up smaller inventories, putting less demand on those supply chains. But now you're seeing potentially less discounting because inventory is built up less. A couple participants remarked about the poor performance of labor productivity. Sure, but we're still rebalancing. Let me look at Wall Street here, and then we'll wrap this up. So several participants highlighted the Fed now has standing facilities that allow for the injection of short-term liquidity, taking treasuries on as collateral, but it seems there's no consensus that these facilities are necessarily sufficient. There's no specific link to the disruptions caused by the debt limit, but we know independently that that is one potential source of a huge disruption later this year, of course. Okay, so bottom line, like debt ceiling is not something we're going to worry about right now, but it would obviously be bad. The minutes specifically mentioned the closely watched PCE core services, less housing numbers, aka Supercore, often monitored by the Fed on a 6-month annualized basis. Here we can see the CPI version of this. Okay, a chart on this, fine, no problem. So in other words, we're basically just seeing Supercore somewhat rotating down quite a bit on a 6-month annualized basis when you take out when you get to essentially Supercore. However, a tiny little uptick here recently. Obviously, we just need more data. Okay, look, here's my bottom line on this, especially since stocks are taking a leg higher. I mean, that's kind of what we expected. We expected this to be mostly nothing. Oh, now just in the last minute, the S&P dropped a little bit. That's interesting. Let me see if there's any note why, because they were just moving. Yeah, now actually the SPY just went negative. That's really interesting. Nothing scary in this. And just, I don't know, that was about 7 minutes. Stocks are taking a leg higher now, but 7 minutes ago has now turned to SPY going negative. Fascinating. You know, I can't really say what's going on with the short-term speculation. Maybe people were expecting this to be a nothing burger of a report, and we're making bullish calls on it. But my takeaway on this, okay, we're going to have some lingering effect circulating through Wall Street around the two things. Number one, people are going to be, hey, wait a minute, you know, you've got potentially a few members of the Fed talking 50. We're not going to get 50. It's going to ruin their credibility. They would have never down-legged from 50 to 25 if they thought they were going to go back to 50. It's going to make them look even more loony and less credible than they already are. We'll just get 25s longer and for more. We've already been expecting them for March, May, June. No cuts this year. It's really not that big of a deal. But I don't think we're going back to 50. That'll make for good clickbait, though, at a lot of news agencies. The second big thing I got out of this was them talking about valuations still being substantially high, specifically mentioning the S&P 500, could be why we're going negative on the S&P 500 right now, but also specifically housing, commercial and residential real estate specifically outed as still at relatively high valuations. So speaking of which, I got to go look at some real estate right now for a house hack. So thank you so much for enjoying the FOMC minutes with me. In my opinion, overall, the fact that they scrubbed disinflation out of the whole report, not that big of a deal. Some of these things, I don't know how much it'll really matter. Those two notes, though, could drive yields up a little bit higher. Both the housing note, the S&P 500 note, and the note on a few Fed folks looking at potentially 50. But beyond that, really nothing scary here. I'm not terribly worried about any of this. This isn't changing anything for me at all. But I do think it's very interesting the Fed is specifically targeting housing, because that's been my expectation, that they don't care if stocks go up as long as the 10-year Treasury yield stays up. So if you want stocks to go up, you actually, in this weird, twisted way, want to see the 10-year Treasury yield stay high. That's what the Fed's trying to engineer. That's my opinion. Thanks so much for watching. Check out the programs available in your link down below. See you later.